Okay, I'm just gonna start real quickly. For those of you that don't really know, Jeff and I, we started out as investors. We bought our first property when we were 23 with creative financing. While Jeff had his own landscape business, he also was reading every single real estate book he could get his hand on. So he studied real estate, he studied creative things to do with real estate, and we were able to build a really great portfolio of real estate, and some of those deals were with creative financing. So he's very good at doing lease options, seller finance, and because he does have that broker personality, he really loves the details. And so it's really important to him that all of us understand how it starts and understands the basics of it so that we can get more creative with the things that we're doing. And
You don't have to look at the screen.
oh,
Look at these lovely people.
oh, I'm looking at the screen, not up here. Yeah. But anyway, so that's why we wanted to put on this class, so we can help those of you that do have deals that are coming up, so that you have the ideas of what you can put together, and then we can go in, we can dig deeper in another class. So anyway, Jeff is here to present.
Yay. All right, can you guys see my screen? Did I share that properly? Yes, thank you. Well, I'm looking for acknowledgement because I asked a question. She likes to. Okay, so this is weird. I'm wearing the same shirt. Wow. That's where I didn't think that through.
You're in that shirt too.
Right. So you guys, that QR code on there is just simply my contact information. It goes to a little app page that has all my social media things too. A lot of you have that contact information, but if you want to reach out, if you want to connect, scan that and pull that up and save that contact. It's got a little URL link. So we're going to be talking about creative financing today. We decided to do this class because sometimes questions come up and then we kind of go really deep on one little tiny part of creative financing. Hey guys. And so I decided, because of feedback, that we would just kind of like tone it down, bring it to the basics, tie it together, compare traditional financing, traditional transactions that we're used to in real estate to the creativity that comes. So let me start with a couple of questions. How many of you ever gone to a bank or a lender, or your clients have taken out a mortgage? You're all wrong. We don't go to a bank to take out a mortgage, we go to a bank to take out a loan. We give the bank a mortgage. Isn't that weird? The mortgage is security for the lender so that they will get repaid. Okay, think about that for a minute. And I got you on that one. So in Utah, we're a trust deed state, right? Some states deal with the mortgage, some states are trust deed states. So those of you that have a loan on your property here in Utah and the trust deed has been recorded, who legally owns the property? Ian says he does.
In Utah, we do.
You're wrong too.
Dang it.
You're wrong too.
The more.
The trust deed in Utah is to secure performance of the repayment of the debt, but the trustee, why it's called a trustee, the trustee legally owns the property and holds title to that property until you pay off the mortgage, until you pay off the loan. You have equitable title, equitable interest in the property. You have the right to occupy it, improve it, do whatever you want with it. But in Utah, the trust deed is important because the trustee can foreclose on the property if you don't fulfill your obligations, right? I'm not going to go too deep in this, but the difference between a mortgage and a trust deed in a mortgage state, if you have a mortgage, you do legally have title to the property. The difference when you don't pay that debt is the lender has to go through the court system to take back possession of the property. Where the trustee, since they already have legal title to the property, can simply start the foreclosure process. The only reason I brought up those couple of little things is I want you guys to think differently. I want you to think outside the box. I want you to question maybe the way things have always been told, taught or told, or what you think something means. Like here's another one. And now you're on to me. But how many of you have been to a closing before? You're on. Yes. So. Closing happens when the title gets recorded at the county recorder's office. We go to settlement. That's what it's called, but we often just call it closing. I've got a closing tomorrow. I'm excited, right? Gonna get the commission check, blah, blah, blah. But so terminology sometimes doesn't actually fit what we're talking about or what we're thinking about. So let's see where I wanted to go next here. So Lynn mentioned our first purchase on the property. And this ties in with those things I just brought up to you because we don't know what we don't know, you know? And it's not that you're wrong thinking I own the house. You do own the house, it's your home and all that stuff. But when we were looking to buy our first property, this was back in 1991, guys. And everybody told us no, you don't make enough money, you don't have credit, you cannot buy a house. Because traditionally, you gotta have good credit, you gotta have down payment, you've got to, the lender is going to loan you the money to buy the house. And we were told no, by everybody we talked to. But we kept looking. Some of you have heard this story before, but we were out basically just window shopping. We knew we couldn't buy a house, but we were looking at them anyway. So we were looking at a townhome in a complex and it was beautiful. We loved it. We're leaving. It's like, oh, that's nice. Someday we're dreaming, right? We're young, we're 21-year-old kids. And a broker was just putting up a sign in front of her townhome that she was selling. She's like, hey kids, if you're looking to buy in this complex, come see my property. It's way nicer than the one you just came out of. And so we're like, okay, I'd love to see it, but I just want to tell you up front, we can't buy a house. And she said, that's okay. Come on, let me show you anything. Like, whatever, you know, we're window shopping again, right? She tours us through the whole property. She shows us that her basement is finished, the other one wasn't. It's upgraded, new carpet, all this stuff. And then she's like, how did you like it? And we're like, freaking loved it. I just wish we could buy it. But we can't get a loan. And she said, oh, that's okay. You can just take over mine. And I was like, that's a thing. You can just take over somebody's loan. And so we didn't know, or I might have been searching for a scenario that fit my circumstances. We happened to just collide with somebody that educated us and we were able to take over that loan. The cool thing about that is we took over a loan that had already been paid down 13 years. It only had 17 years left on the amortization. So creative financing from that day forward became my jam. I'm just saying. So what I want to do today is just kind of talk about the difference between a traditional traditional transaction and our options that are available to us for creative alternatives, okay? So that we don't get pigeonholed into this is the way things are done. So here's some of the things we're going to talk about. We're going to talk about who makes the rules. I just kind of mentioned that a little bit. What documents and terms are involved. Now, each one of these things, I kind of want to do a little comparison. You know, who makes the rules traditionally, and then what else is possible? Who handles the closing? Who collects the payments? What type of a buyer and seller is creative financing for? Right? Who would be a candidate for this type of a transaction? Because not everybody is, right? And I'll give you some examples of that. And then we're going to talk about some creative financing options. Like there's multiple different ways. It's all wrapped into creative financing, right? And then that last one was what to look out for, because shit can go wrong, right? And so keep in mind, that's what contracts are for. Contracts are to outline what happens when somebody doesn't fulfill their obligation. It's already predetermined. You've already had that meeting in the mind to say, yep, I'm going to do this. And there's always that clause in there, default, right? Well, what if you don't? What happens? And so we got to know what can go wrong in order to put things together properly. So participate with me here. Did you hear that little teenage voice crack? That was weird. In a traditional transaction, who makes the rules? Typically. Correct. The lender. Most of us need to borrow money to buy a property. So the lender says, we will loan on these conditions, correct? So the lender makes the rules. This is just a list of some of the things that they're going to require of you. They're going to have minimum standards that you need to meet, right? You have to have a minimum credit score or no bueno. You're not going to get the loan. DTI, debt to income ratio. You can only have so much debt based on what your ability to repay the new debt is going to be. Verification of your assets, your income, your employment. They're going to look at all that stuff. They're looking at this picture because they're risking giving you the money, they need to mitigate that risk by saying, okay, you've met these standards, you pay your bills, you have a credit score, which is just scoring your ability to pay debt. So if you've never taken out any loans, you don't have a credit score. Okay, so debt is good in some ways. They're gonna tell you how much you have to put down on the property, minimum. You can put more, but say 3%, 5%, 10%, 20, whatever that might be for your circumstances. And they might require mortgage insurance, right? So who makes the rules outside of that when you're talking about creative financing?
Yeah.
Exactly. So we've got a buyer and a seller. I was talking to James before this, and it's just like creative financing encompasses so much. It's basically whatever two people want to agree upon, right? And so all the terms are negotiable. So some of these things in this column certainly might apply. If you're the seller, you still might want to see my credit, right? You may want to verify my income. But I'll tell you, often, a lot of these things get skipped in creative financing. If you're going straight to an owner that has a property that they're selling and that maybe they have a distressed situation, that's what they're concerned about. They're concerned about stopping a foreclosure. They're concerned about their divorce. They're concerned about whatever has put them in a situation where they need to sell. Usually, not always, and we'll talk about some of the ways, but normally when creative financing is involved, it's because you're finding a solution to a problem that can't, or maybe they don't know that can be solved otherwise. Does that make sense? So creative financing is when people talk about seller financing. Well, what is that? What is seller financing? It can mean so many different things. So, like I said at the start, I want to kind of compare the transactions so you can see, okay, this is how we've done the traditional way. And it's very similar if you know how they mesh together. If you know what you're trying to accomplish, you need to be open to think what else could work. You know, like in our case, when we were so young, we didn't know what we didn't know. So the banks told us, no, we can't get a loan. We didn't say, well, how else can we buy a property? Let's investigate this subject. We were just like, shit. So, but we're interested in real estate. We want to buy a property. So we just kept looking. We kept that energy and we wanted to buy a property. And so that's how serendipity happens, right? We serendipitously met somebody that educated us and showed us how we could buy a property without getting an institutional loan. And we still own that property today. So documents and terms, spit out some things that we're going to use in a traditional transaction. How about a purchase contract? I'll start joking. All right, let's just pull them up there. So just in its simplest sense, right? And you guys on Zoom too, unmute yourself anytime, interrupt me, ask a question, ask me to back up, move on, whatever. You guys are participating here as well. But the documents, typically, we're just going to look at the standard documents, Rep C, and any addenda that are applicable to that. Now, most of us are real estate agents as well. So let's separate the thought process. You're thinking about this, what you need to do for your clients, right? You're required to do certain things. There's disclosures and there's other things like that for your clients. Now, if you're a principal, if you're making an investment on your own and you're dealing right with the owner and or even with another realtor, but you're the principal in the transaction, a lot of those rules don't apply, right? Those are in place. The Utah Association of Realtor forms are approved by the attorneys, reviewed by the attorneys on a regular basis, and we're required to use them if they exist, right? Like the REPC, the real estate purchase contract, they provide that for us. You can use another one if an attorney prepared it, but by default, you're going to use the approved state forms as a licensed realtor. As a principal, again, you can do whatever you want. You can write out the terms of your contract on a notepad. You can borrow one from another, local RIA group or something. You can basically whatever outlines the terms of your agreement, you can use. So traditionally, we have these things, and there's certain terms that are in all contracts, right? It's going to have the inclusions, the exclusions, things like water rights, prorations, home warranties, mediation. Those are all fill in the blank parts on the contract, right? There's preset clauses that we don't edit and we don't change unless we do it on an addendum. But those are some things that we're gonna automatically, how do we want to answer this situation? Earnest money, due diligence, financing, appraisal, all of those things apply in a traditional transaction. Creatively, though, you're gonna have some additional documents or different documents. So let's say we're working for a client. There's a UAR form for seller financing. There's a seller financing addendum. Has anybody used it before? A couple of you. So that seller financing addendum helps us fill in some of the blanks, but like I mentioned earlier, whatever two people can agree upon, you can essentially do. So when we're talking about like interest rate, for instance, the bank says, this is what the interest rate is that we're gonna loan the money at based on today's rates, right? I think yesterday, I wrote it down, it was like 6, we're right around 6. Let me pull it up, so, because I'm gonna refer to this later. So yesterday was for an owner, 5.99 on a conventional and 5.5 on an FHA. For an investor, 6.625. And if you know what a DSCR loan is, debt service coverage ratio, 7.375. So that's just what it is, right? And you lock that. You say, yep, I'm moving forward. Let's lock in that rate. With creative financing, you want it to be, right? If you want it to be fixed for the entire term of the agreement, you can fix it in. You can have it adjustable. You can have it variable. So an adjustable loan is going to adjust based on some index, right? Or I mean, a variable rate is going to adjust based on an index and say, well, if this rate goes up, so does yours. An adjustable, you could predefine that. You say, hey, for the first year, let's make it 6. For this second year, we'll make it 7. Whatever. So I bring that up just like because you can come up with whatever you want on there. The amortization schedule as well. The banks dictate how they get paid back, how much money goes to interest, how much money goes to principal. Well, when you're doing it creatively, you could say, you could mirror that type of a transaction, right? Or you could say, you know what, let's just make it interest only. I'm not going to pay down any principal. I'll give you X amount interest rate, and we'll just make the payments interest only. And interesting, right? You don't have that freedom on a traditional transaction where there's an institutional lender involved, because again, like they make the rules. So set that aside when you're trying to find a solution to a problem, where you're trying to creatively purchase a property. What will work, right? There's balloon payments and calls on notes. When you take out a note, it could say, hey, you know what? I'll take $5,000 down now, but in 2 years, I want another 5,000. That's a balloon payment, right? The call date on a seller finance is going to be, okay, we're going to do a 30-year amortization schedule, but I'm only going to give you 5 years, and then you got to pay me off. You're predetermining the call when you got to pay off that note. That's not typical in a normal bank situation, right? So that could be 5 years. There could be a right to renew. If I sound like I'm jumping all over the place, because I could just spit out 1,000 different ways you can do a creative situation. So when you've got a client, let's like compare this to our clients. Sometimes they go to the lender and the lender says no. Okay, especially if they go to a credit union and say, well, this is our loan product, you don't fit that mold. You go to a broker, they might have dozens of lenders that they can look at and say, well, this one won't do it for you, but this one will, right? And then in some circumstances, like, dude, you just filed bankruptcy 6 months ago. We can't get you a loan until X. What do we normally do? Okay, well, we'll stick with them. We'll follow up with them. When they're ready, then we'll get them an additional loan and help them buy a house. But what if there was another way? What if you could maybe get them into a home with creative financing, and then they could get their traditional, oh, I should probably plug this in. Sorry. Time out. My battery's going dead, but it is plugged in, so. Oh, that would really suck if this goes dead. Okay, can you hear me? Okay, thanks, Phil. Conrad's just staring at me, making eye contact, but all right, you guys didn't go anywhere. We just had a little break there. The power went out on my laptop, and let me reshare the.
Still recording.
Yeah, it says recording. Okay, I gotta re-engage my screen. Hold, give me 1 second. Sorry for this little intermission here. Get creative. Where's my tech guy? Where's my tech guy?
That was secretly planned.
What,
See,
so
when
you could,
things don't go to think how you want.
and you didn't need
just
that,
stay
that.
creative.
For the presentation.
This is as fast as I go, guys, sorry.
Who's your tech guy? Yes.
All right, there's that. I'm coming to fix my screen for the kiddo. Can you guys see my screen now?
Oh, it doesn't.
Thanks,
say
Phil.
that. It doesn't say that.
Yeah, we can see it.
All right, let's get back to where we were. Okay, I already mentioned that part. If you're acting as a principal in the transaction, those UAR forms, you're not, you don't necessarily have to use those. The requirement is, hey, you're representing the public. And so there's certain standards we have to meet. There's ethics and there's also disclosures, and there's documents that use these. Otherwise, can you imagine the Wild West? It's like, Ian, what contract do you use? Don uses a different one. And it's like, there's no symmetry to a transaction. That would be horrible. So in creative financing, though, it is the Wild West. You can do whatever. And so I'm going to talk a little bit about what can go wrong later, and then bring up that question again later as well. But lost my train of thought on that. It'll come back to me. Okay, let's move on from this, and we're going to get to some examples. Any questions so far? You guys on Zoom? You guys? Anything I really went over?
About this seller financing. There's no any title company, I mean, involved in the transaction, right?
There's a title company.
Title company, do they do one?
It can be. In fact,
Can be, but it's not.
that's my next slide.
Okay, I just.
Yeah.
thinking about
No,
it.
you're exactly right. I mean, who handles the closing?
Exactly.
So Arlene just brought up the next point of the traditional transaction, right? Traditionally, we're going to go to a title company.
Oh,
In some states that are mortgage states and other states, it's going to be an attorney, right? They don't use title companies. We're a trust deed state. We're going to close a title company, and this is their job, right? They're going to issue title insurance. They're going to collect all of the funds necessary to purchase the property from the parties involved, whether it's a loan or your down payment or gift funds, whatever. The money comes in and then they disperse, right? The title company is going to record the transfer of title to the buyer. They're going to use, typically they're going to use a warranty deed or a special warranty deed. Who knows the difference? Skyline. You know, she's 7, but she'll know this by the end of the day. So a warranty deed is you're signing a warranty deed, so you as a seller are warranting the title of the property. There's title insurance, but on a warranty deed, you're giving a warranty that there's no clouds on property that you're aware of, right? Or that you've created. A special warranty deed is saying, hey, I'm not warranting this to the beginning of time when this property was built, but I will warranty it from the time I owned it. I did not do anything to cloud the title when I owned it that hasn't been, cleared out. Or banks, for instance, use special warranties all the time. When you buy a property that's bank owned, it's been foreclosed on, the bank owns it now, it's an REO, right? Real estate owned. You or your buyer buys the property from them, they're not going to sign a warranty. It's a special warranty deed that said, hey, we just took this property 2 months ago. And we warrant the title during that period. Okay. And then I mentioned attorneys in other states. So creatively, to your question, who does the closing? And it just kind of depends. You've heard of kitchen table closings, right? Investors going, meeting somebody at their house, bringing all the documents, making an offer, coming to a meeting of minds. They sign all the paperwork right there at their house. that investor can now take that deed, if it was notarized, when they signed it, and go down and record it, and they own the property. There's not a third party involved. So, and this is kind of a problem I have with creative financing, is it is rampant with fraud. It's so easy for those that know this much to take advantage of somebody that knows nothing. We were just talking yesterday to somebody, and we were talking about this, and I had a friend of a friend call me. He was referred to me because he needed help with the situation. He had loaned somebody some money so he could remodel his house so he could sell it. And he was having trouble making the payments, and he was looking for a way out. I got to save this house. I just put all this money into it. It's so nice. I've got a ton of equity. And so I was going to meet with him. And in preparation of meeting with him, I did a little due diligence, looked at his situation or whatever. So when we got together, and I remember I met him, or he came and met me at my son's football practice. So I took a little break and we got up in the truck, and he started going off on his whole situation of where he was at and the problem he needed to solve. And I had to stop him. I said, whoa, 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 let's back up, because you don't even own your property. He's like, what do you mean I don't own my property? I said, the title's in somebody else's name. He's like, he had no clue what I was talking about. But when this person loaned him money and they signed all the documents, he signed a warranty deed and deeded his house to this hard money lender, and had no recollection of that. So that was the first problem we had to solve. He wasn't even on title to his own home. Crazy, huh? So that's what I mean by it's easy to take advantage of people.
You know, I actually had someone meet with me, last year, same thing happened. Really cute, couple actually entrusted in someone that was going to give them some money to remodel their house. And she couldn't get the help because she only spoke Spanish that she needed, but she deeded her home to someone.
Walk up closer to it.
Anyway, she deeded her home to someone that was actually, a person that was doing a lot of fraud throughout Utah, ended up going into jail. They couldn't find her, but that does happen, where people that are really innocent trust someone and they do that they just put a stack of paperwork in front of them, and literally she's been making the payment on her house for 10 years. And it's in this other person's name. And so I got her in touch with an attorney, and they finally got everything figured out and fixed. But what a sad situation. So
if you made a payment on the property for 10 years, she didn't even know.
exactly, but she knew it was hers, she knew the situation, but no one would listen to her. And so getting to the right people, and that's why my friend brought her to me, I could help her get to the right people. But that's why I love being in real estate, is that we can protect people in those situations. Hopefully they come to us first.
Absolutely. Guys, if you want to be successful in real estate, just find people that you can help. Our main job, in my opinion, is being protectors. I truly believe, and this isn't ego, but I truly believe when I'm talking to somebody that needs to buy or sell real estate, that the best thing they can do is hire me, because I 100% am going to help them get the outcome that they desire, right? And so, in my opinion, it's a crapshoot, unless they get with one of you guys, of course. But we all know that there's a varying degree of education and experience, ethics and stuff in real estate, unfortunately, but that's true of any industry. So we're protectors first. So one way to really increase your business is find people you can help. A lot of you know that I started my real estate career reaching out to people that were in default, and this is in 2009. So if they were in default, 99.9% of the time they're underwater as well, right? They owe way more on their house than they can sell it for. And so my plan was to help them get a modification with the bank and save their home from foreclosure. Had nothing to do with me. That's the best option. Would you agree? That's the best option for them. They didn't want to lose their house, but they're getting all these letters from investors, from realtors that want to list their home, and investors that want to buy their home, and they want to save their home. So it's a great foot in the door to show them that you're concerned about them. And I did a lot of modifications and didn't get compensated for it, because as real estate agents, we can't charge for modifications. But I built some really great relationships, and not all of those lenders would agree to a modification. And so a great number of them turned into listings. but we started there first.
I don't know how to make a modification, how as a real estate agent do that? Or is it just a third party that comes in and talks to the bank?
I assist them, yeah, I'm a third party, right? So they sign an authorization form they're authorizing the bank to talk to me. Without that written authorization that's sent in, that's step one, the bank's not gonna talk to me at all. I'm gonna call and say, hey, I'm trying to help somebody out, it's like, so, you're not alone. But when they have that authorization, it's like, oh, okay, you're Jeff, they signed this document, they went through whatever their hoops were to give permission to talk to me, and now it's as if I'm the seller calling. And a lot of times I would do that first call with them and initiate, and they're talking, so they're talking to the lender, I'm talking to the lender, we're finding out the rules. How do you like to receive the authorization? This is who I am, and they go through all their security protocols with the seller and give their social and all this, and stuff, say, I am the owner of the home, and then sometimes even verbally, they'll let me ask questions and everything in that very first phone call.
There were companies that started a business doing that, and they would charge $5,000 and $6,000 for that. So you had these people losing their homes that had no money, and you were charging them $5,000 or
But
$6,000.
in Utah, that was illegal, so you have to be a licensed attorney to charge money for that. Anyway, that's another topic, but talking about the closings, to your question, typically, we're gonna go to a title company, right? There are some that are done with an attorney here, but in creative financing, it really just depends. And so go back to what we were talking about earlier, being a protector. What's the best thing to do for your client? And what's the best thing to do if you're a buyer? What's the best thing to do for them? I used to close my lease options at the title company. Nobody does that. And we'll get into that in an example. Who collects the payments in a traditional?
Mortgage company.
Can be. Escrow account or a servicing company. It's usually a third-party servicer. Some lenders have in-house servicing departments that collect the funds. And often we'll get a letter saying, hey, your loan's been sold, there's a new servicing company, send your payment over here. Which, just as a warning, verify that. That's another area for fraud. Because Lynn and I have a decent portfolio of properties. We have mortgages out there, more mortgages than just our home, right? And so we get letters from time to time from servicing companies stating where we should send our next payment to, and our loan hasn't been sold. So always check with the lender when that happens. But a servicing company can be in-house or a third party. Oh, I already mentioned that. Loans are often sold. With creative financing, again, it depends. Some people can make their payments straight to the seller. Right? You did a creative situation, you got a seller finance agreement. The seller is collecting, whether they got underlying debt or not, they're collecting a payment from you. They're now the lender of sorts in a seller financing situation. You could make the payments right to them. There's a lot of reasons why you wouldn't want to do that, though, that we're going to talk about. Or to protect yourself and just to keep everybody honest, you would make your payments to an escrow company, a third party, again, that you can bring into the transaction that isn't necessarily required, but they're going to keep the records, they're going to follow the terms of the agreement, they're going to, reach out if the payment's late and collect late fees, and they're going to handle the money, and it costs hardly anything. It's like so smart to do. And I think I have an example coming up on another slide of one that went bad that we did, that we were paying the seller directly and he wasn't making the mortgage payment. That's no bueno. Okay, moving along. Who are some people, or what kind of situations would sellers be in that creative financing are for? What type of a seller would consider seller financing, would you think, or in your experience?
Distressed properties or distressed situations, divorce, separation, under their husbands.
Yep, Aaron said distressed situations, people that are in distress and haven't figured out on their own how to solve their problem. That's where you could come in as an investor or as a realtor and help them discover what they don't know. The last thing we want, and I mention this all the time, the last thing I want to ever hear from my clients is, I wish I would have heard that sooner. Or why didn't you tell me that sooner? To find out something later, it's like, oh my gosh, if I would have known that then, I wouldn't have lost my house. We don't know what options, they don't know what options they have. Just like Lynn and I didn't know what options we had when the banks kept telling us no. It's like, crap, I guess we can't buy a house. Well, let's, keep working, plugging away someday. And then we found out, oh my gosh. We can. I'd never even heard of this. When she said, you can just take over my loan, I'm like. It would never even occurred to me, hey, you want to just give me your loan? Because I hadn't been educated. I hadn't studied at that point. I was young, I was naive. I knew what I knew. You want to buy a house? You go get a loan from a bank, right? So here's some examples on there. Tired landlords.
Oh my God.
Not this land. Yeah, she is a tired landlord. Yeah, that's funny because my daughter, sorry that the mic was all weird because we were laughing at the same time. That's not my wife that I'm talking about, but actually my daughter was laughing because my wife is the tired. Well, at least we think so.
I thought you were trying to be funny and she's out.
And she just walked away. So let me give you an example of a tired landlord. Lynn was a friend that I met because he lived in my neighborhood. We got to be friends because I was just starting my investing career. He had started in the early 70s and had a bunch of properties that he had owned all this time. They were paid off free and clear, and that's pretty much what he lived off in his retirement. But he was tired. He was done with having to fix up the property, maintain it, collecting rents or whatever. And so I became his best buyer because I had been studying creative solutions. And the reason it was important to Lynn is because he had bought his properties in the 70s, didn't pay very much for them, obviously. They had been depreciated out. He had no more tax advantages for them. If he sold them, he would be selling them to get rid of them. He didn't want to be a landlord anymore. So what would he have? Capital gains. He would have to recapture all that depreciation. He would have not very much left over to then reinvest to try and get some income to live off of, where he already had the home that was creating income to live off of. Okay, so that's a win situation. It's like, hey, your money's already invested. And in this case, I lease optioned the properties from him. I didn't do seller financing originally. I became a lease option tenant, even though I wasn't going to live in the property. Eric and I did a lot of lease options back in that day, early 2000s, because it was a solution to a problem. I said, I'll be your tenant and I'll take care of the property. I'll take care of all the maintenance and I'll pay you on time, but I'm going to sublet. I'm going to put somebody else in there to live in it. But what I do, I solved his problem. I stepped in as the landlord of sorts because he didn't want to I took on the responsibility and the burdens that he didn't want to do anymore. And he kept getting his rent every month. Pretty good situation, right? So there are landlords out there that are like that. They need the income. They don't really want to do a 1031 exchange and buy another property and do all this stuff, which are other options that's not about this class. But you could offer a creative solution for them. What do you think the difference is between a tired landlord and a reluctant landlord? A reluctant landlord is somebody that's probably having to rent their payment because of the situation where they can't afford to make the payment themselves, and so they're going to rent it. They're becoming a landlord without really wanting to. Amy was somebody whose home that I took over that was in that situation. She was building a new home. The construction was finished. It's about to move into the home or into our new home from the home they had lived in. She couldn't sell it for what she needed to get out of it, to sell it and then move on. It wasn't selling. And so this is going back a little while, when I was doing lease options, my little game plan to find who eligible people that would do lease options was call for sell by owners and ask them, like Amy, if this doesn't sell, what are you gonna do? She's like, I'm gonna have to rent it. I don't want to rent it, but I'm gonna have to rent it because I can't make 2 payments. And as soon as I move into this other house, I'm screwed. There's whatever the rent payment was, $1,500 back then, or it wasn't that much. She didn't want to have to pay that. So I said, well, how about I rent it from you and I'll buy it later. That's a lease option, right? That's a rent to own. That's one method of creative financing. So I solved her problem by making it so she didn't have 2 house payments because I absorbed the one and then I rented the property out. So thinking like that,
You just rent the house, you don't get the title. So you just renting.
on a lease option, yeah, you're leasing it with the option to buy. I'll go in, this is a whole nother class. I'm trying to give like an overview right now today of the basics, but we can do a whole class just on lease options. So for instance,
And then like over the next 6 months, you just do one class every month on all these different options. That's what I like, they got it set up.
so with the lease option, the way I would do it is I approached sellers like this with a lease option because everybody else wanted the deed. Everybody else wanted to do seller financing. They wanted them to give them the deed to the property. Well, the seller's got some risk there, right? So when I come to you and everybody else wants you to deed, and you're not an investor, you don't know. It's like, well, I'm gonna deed my house to somebody, but I still have this loan that I'm liable for. How does that work? And what if you don't make the payments? There's so many questions, right? So it's a no. There's too many questions. So when I came in and said, well, just rent it to me. If I don't make the payments, you get evicted. If you sell the house and they don't make the payments, you have to foreclose on them. So I showed them that I was keeping them in control. So I would lease the property with the option to buy it. So I had a set price, I had a set time period, I had an option to buy it at that price down the road. Question? Oh,
Well, I was just gonna say, and with that, it's between you and the seller that can negotiate whatever those the lease terms are.
correct.
So it doesn't have to be any, it could be whatever.
So think in your mind, seller financing, the seller is going to sell you the property and you're going to have like a set payment, a set purchase price. It's the same in a lease option. The paperwork's different because they're not transferring title. They're giving you an option. And so there's still a set payment and there's a set price that you'll pay at some point in the future. But an option is the right to buy the property, not an obligation. So if something went wrong, you lost your job or whatever, and you could not exercise the option, and maybe you couldn't think of something creative to renegotiate, you could just give the house back. You know, no harm, no foul. It was an option. I didn't exercise my option. There you go. So as the master, they call it a sandwich lease option because I'm a lease tenant with the owner. I'm in the middle of the actual occupant. So I'm in the middle here from the seller. I'm a lease option tenant, and then I would lease the property out to the actual person that lived in the property. And of course, making an investment, and that's why this is another class, but there's so many terms that you would negotiate, right? My payment had to be less than I could charge. So I had cash flow and my option, if I gave a lease option to the next buyer, they had to pay me more than I had to pay the seller, right? There had to be a spread in there somewhere or it wouldn't have worked for me. We won't go too deep into that, but maybe we can talk after if you get a specific situation. But that's just one way to do creative financing is that lease option. Let's move on to the buyers. What time is it? Oh, check.
11:47.
I'm likely gonna go over, so if you guys need to leave right at 12, no problem. I am recording this and we'll get you a copy. But if there's questions and stuff, I'm willing to stay on here. And that just made me see that there's something in the chat. Just people laughing at Lynn. That's good. Oh yeah, Christopher says one of the situations that he was throwing out there when we were talking about the type of buyers or sellers that might be interested in creative financing is a newly married. Now there's two homes. They got newly married and they got these two properties, and maybe they can't make the payment on both and don't want to sell the other one. Let me leave that open. So for buyers, the most natural type of buyers that you would think of as an investor, right? When we think creative financing, seller financing, some of the things we're thinking, yeah, that's investor world, right? But it's not just for investors. But why would investors be interested in creative financing and seller financing?
Oh, because it's so much easier.
Because it's so much easier, Aaron says.
They don't have to go to the bank and all the procedures.
That's the main reason right there. We started with that slide. Who makes the rules? The lenders. The rules are steeper for investors, right? Bigger down payments, higher interest rates. The banks make the rules. So if they don't have to go through a bank, they got the freedom to negotiate with that seller on what would work for them, while also taking care of the needs of the seller. So no brainer when it comes to why investors want to do creative financing, right? A bank might say you got to put 20% down, or if they own multiple properties, maybe it's 25% down. But it's possible to do a lease option with, or I'm not just a lease option, but creative financing, seller financing for far, far less. So let's say they have 20%. I mean, on a simple math equation, that maybe they could do a seller finance and put 10% down on this one and 10% down on this one, so their same liquidity gets them 2 properties instead of 1. By negotiating the terms with the seller. Self-employed people, there's new loan products out now that really help self-employed people. But a lot of us that are self-employed don't show a lot of income. So that might be a situation where a buyer's like, hey, if I could find another way to buy a property, right? And then what about the people that have a down payment, but they don't have a credit history or maybe bankruptcy? I mentioned that earlier. What if they just filed bankruptcy 6 months ago? Do they really want to wait the lender required waiting period before they can qualify for a loan? Or is it possible for us to get that buyer into something short-term creative financing so that when their bankruptcy is seasoned, the banks will loan them the money to refinance that property if they bought it on a seller financing? So don't forget about your buyers that have issues. Always be thinking, well, what else could we do? Like Lynn and I, we didn't think that way, but if we would have, what else could we do? The banks are saying, no, what else can we do? And pursue that.
Yeah, well, for bankruptcy, lease options seem like to be a really good option.
Correct. And what you would want to do is just paint the picture. Let's say you're representing a buyer that needs that situation. You would want them to get pre-qualified, pre-approved, and the lender saying, not right now. But what is he gonna say? If you do A, B, and C, then you can get a loan.
Do a 5-year lease option for 5 years and.
Correct. Correct.
Conventional after that.
So your lender is gonna actually be your, just like in a traditional situation, your backing for the financial ability, even though it's not now, he's as a third party, as a lender, going to be giving credit to the financial ability to that buyer. He's gonna say, yeah, in 18 months, their goal. So maybe you do a 2-year lease option or something with the right to renew, just in case something happens. But you've painted the picture on why they can't qualify right now, why they need seller financing. And if that satisfies the needs to the seller, then you can move forward and they know it's only temporary. You're gonna be paying off their loan.
I had something on that, like, I had a friend who did a lease option from somebody, lease to own,
Mhm.
and she didn't use a realtor, she didn't use anybody, and the owner said, yeah, you can fix this up, you can paint that, you can do this. And then at a certain point, the owner said, hey, you know what? I'm gonna evict you, you're done. So she got kicked out after she had invested like 20 grand into the property.
And she was just a tenant.
And she was just 10. I mean, with the option to, and
They can do that.
yeah,
She had an option to buy the property.
it was like a lease to own thing. I don't know the whole situation, but I know that she went into it just with looking on like Craigslist or KSL, found a property. Oh, this helps me out. I can't get a loan, so this is what I'm gonna do. She didn't talk to any professionals or anything.
Right. So without seeing the documents and what the option
Yeah.
said, I don't know what her specific situation is. But let me go back to the fraud part of this, okay? Because Lynn and I own a lot of rental properties. And so people are applying to rent our properties all the time, right? So what do we hear? All their horror stories about where they used to live and what happened. And sometimes they do bring the contracts and show us. I'm like, shit. Because like I said, it's the Wild West. You can put whatever you want in the contract. Okay, we've seen option contracts that people have paid $10,000-15,000 for that option. That there's a line in there that says that if you're 1 day late on your rental payments, you lose your option. Crazy, right? You think they spend a lot of time talking about that with them and enforcing it? Hey, just want to make sure you don't make a late payment, because if you do, you lose your 15 grand and I'm evicting you. You don't have, you're in default, you're out. But it happens. So she was probably taken advantage of by somebody that knew more than she did. She thought she was being given a great opportunity. She didn't get third-party opinion, an attorney, professional, somebody to look over the documents, give her advice. She just moved forward, right? So that's where we come in. Did you have your hand up? Okay.
I'm stretching.
Oh.
So I know about some seller finance transactions with other people that are buyers, they only get the first contract for the
Mhm.
they don't get the title, they don't show on the title
Right,
until they pay off the house. So what's the difference between the contract of this?
I'm gonna get to that. No, that's fine, because you're
forget all this stuff.
you're just validating that I put these in the right order. Because that was my hardest part, is why start? And what do I say next? So it all kind of seems together. So you're going and you're projecting forward to the next natural question. We're gonna talk about the difference between seller financing subject to contract for deeds and that kind of stuff. So we'll get to that. And I'll try and go faster. Let me back up. And I use these examples but I'm noticing on this foreclosure one, you see there's an example I want to tell you about Clint. And these are lease option, examples because that was, like I said, that was my main lead in. I discredited everybody else that was trying to get the deed and they're like, I'm gonna work with this guy. He's making it easy. But I also protected myself. And when I say I make it easy on them, I would set up escrow, right? And if I defaulted, I already have signed a quick claim deed, which is giving back whatever rights I have. A quick claim deed is not a warranty deed. It's just like whatever I have, and I'm not warranting I have anything, but whatever I have, I'm giving to you, right? That's what a quick claim deed is. So it makes it easy for them to take back the property if I'm in default, right? But what do I want if the seller's in default? I want a good way to be able to exercise my option, to be able to get the ownership of the property. And this is where I learned a good lesson because I wanted to be trusting, right? I didn't use escrow companies for payments in the early days when I started doing this. It's like, I trust you, we're gonna work all this out, I'm gonna make you the payment, and I'm trusting that you're gonna make the mortgage payment, right? Well, Clint didn't do that. Clint, the way I ended up doing a lease option on this property is he was in foreclosure. So I simply went, he had no equity. And I didn't care because I'm a long-term investor. I was like, if I can control this property, I'm gonna own it for 30, 40 years, whatever, right? And so I went in and caught up the payments. This was the deal, right? I'll catch up all the payments and I'll start making the mortgage payments, which is gonna fix your credit. Because you've been in default, you're in foreclosure, I'll catch everything up. I'm gonna take over the property, but I did a lease option, not a seller financing. And I'm making his payments on time, right? But I was sending the payments to him. Stupid me. He's in foreclosure and I'm giving him money, thinking he's gonna make the payment. But one of the things I set up with my escrow is I had him sign the warranty deed. If he defaults, this is a whole nother class. I'm not gonna go too deep into this, but part of the reason that worked is I told you earlier that I closed all my lease options at a title company. I've heard title people say, we're not really interested. We have no interest in lease options because there's no title insurance. But I took out title insurance on every one of my lease options. I paid for it. I wanted that insurance. And what enabled me to do that, sorry, this is a whole other class. But when I did, all right, say I'm doing a lease option with you, what I want from you is security that you're going to give me the property when I exercise my option. So I can record, I have an insurable interest in that property by just the nature of I have an option to buy it, right? So I took out title insurance and recorded a trust deed. I don't know if there's a future slide or if I passed over it. A trust deed is a security instrument. It has, just like a mortgage, it's saying, hey, this is recorded against the property as security for repayment or performance of an obligation. In most cases, it's repayment of a debt. That's the obligation it's securing. My trust deed stated it was to secure performance of the option. Okay, based on the terms of our agreement. So why would I want that? Here's a couple examples. Let's say I have a lease option with you and you're going to sell me your house at $400,000. And like you're a person, I'm renting it, I'm fixing it up, I'm paying it, but then you get in a financial situation and judgments start getting attached to the property. Or you take out a second mortgage because it's gone up now to 600,000 and you've got enough, you know what I mean? You could take out another mortgage on the property. So now if I want to buy it for 400 and you've taken out more loans and or you're not performing on your obligations and there's judgments attached to the property, I'm hosed. How can I buy it for 400 if there's all these liens on the property? So what does a trust deed do for the typically a lender or the person that it's securing for? Is it locks that equity position. right? We're in a foreclosure state. The lender says, I don't give a shit what happens after me. This is my position on the property, evidenced by this lien, this trust deed. And if all these judgments and all this stuff get attached to the property afterwards, I'm just gonna foreclose and wipe them off.
So you're in first position.
You're in whatever position.
Yeah.
I was positioned behind his lender.
Right.
The lender was in first and I had a trustee for the option. So whatever else happened. So I did think that part through, right? But my mistake was not setting up the escrow company for the payments and making sure that the mortgage was being paid. So all I simply did when he was 2 payments behind, I found out because the lender, or not the lender, my tenant is opening the mail, going through the mail, open it up and said, oh shit, that's not mine. And it was a letter of intent to foreclose on the owner, not even their landlord. And they're like, what the heck? This person on this letter is getting foreclosed on. Lynn's my landlord. What the hell's going on here? So we were tipped off, right? I didn't even have to go through the foreclosure process because I had that warranty deed sitting in escrow. I had an attorney write a letter based on the terms of our agreement and our contract that we intended to foreclose or to exercise the escrow instructions to release the warranty deed to me because of his non-performance. He didn't fulfill his obligation, he didn't make his mortgage payments. So we gave him a 30-day period to cure and catch up the payments. He didn't. The deed was released to me and I went and recorded it at the county recorder. I now own the house. I was a tenant and I set it up properly to where I was able to get the deed for the property. Okay, like I said, we set up contracts, we set up these types of things to outline what happens when things go wrong, okay? Let's move on since I'm way over time. 1201, sorry guys. If you want to stick with me, I love it.
We had that little middle section that doesn't.
Yeah, when it's all clipped down, it's gonna be like 50 minutes. Hey, creative financing options. Arlene was getting here talking about contracts for deeds. So who can tell me what the difference between seller financing and subject to? What does subject to mean? Eric,
Deeding property to someone else.
the subject to portion refers to you're buying it subject to an existing loan.
Right.
Yeah. So in our case, subject to when we bought that first property, we literally just took over her loan. Meaning my payment was now to the mortgage. I wasn't making a payment to the seller anymore. I made the payment directly to the mortgage company. Okay. Seller financing might be different, which is also subject to if there's an existing mortgage on the property. But let's say she said, okay, I've got this loan on this property, but I want you to pay me a little bit more. So I'm going to finance you and then I'll make my payment on the mortgage, but I'm going to charge you a little bit more. Does that make sense?
Seller finance.
That'd be seller financing. So seller financing can be both, but typically when people are talking about seller financing is the seller's the lender. Maybe they own the house free and clear. They're the lender. It's the lender's your bank. It's that simple. I'm making the payment to you. Because not the lender, you're financing the sale to me. Subject to means there's a underlying obligation on there. If you look at the seller financing addendum, you got 2 choices when you're talking about what documents are going to be used. If it's a true seller financing, there's just a note and a deed, or a note and a trust deed, because there's nothing else involved. The other option is a note and an all-inclusive trust deed. Have you heard of that? An all-inclusive trust deed just means we've got this note, we've got this obligation with the seller, but it's inclusive of another obligation. Investors also call it a wraparound mortgage. We've got our deal and it's wrapping, or it's inclusive of another obligation which the seller has. Okay. So I put land trusts on here. I'll explain why people use that when we get to the defaults in a second, or the risks. But a land trust is simply like if you own a property, you can put your property in a trust, right? That's a permissible title transfer when you own a property. Hey, I'm going to do some estate planning. I'm going to put this in a trust. Investors are creative, right? So investors will help that seller set up a trust as long as they still have ownership in it. Then they can put their property in it. What is ownership in a trust? It could be just 1%. Aaron owns 99%, I own 1%. Maybe there's some future event that's gonna happen where I then give you my 1%. Now you own the trust, but you also own whatever the trust owns. So it's kind of a backdoor way a lot of creative investors will use to not make it known that they bought the property. It doesn't put them on title. It doesn't put the lender on notice that the title's been transferred, those types of things. We can go into another time. But as far as seller financing, what are the two most popular ones? Arlene brought up contract for deed. Contract for deed is where you get to move in the property, you get to use it, you have an agreement, the terms are outlined, the payment, when you're gonna pay it off, at what purchase price, but the seller retains the title. He doesn't give you the title until you've performed on the terms of that purchase, and then you go on title. So it's kind of similar to what we do here in Utah, if you think about it. You know, now we got, like I started out this class talking about the trust deed of the creates the trust deed, has the legal title to the property. They're holding the legal title to the property, and you have equitable title. But in that case, you're actually up here in the county recorder's office as the owner, right? But if there's a trust deed on there, that means that the legal title is sitting with that trustee. With a contract for deed, you're not showing as legal owner of the property. The old seller is. Same agreement is in place, right? And you'll get put on title after you exercise it. So think of like buying a car. They hold the title to your car until you pay off the loan they gave you to buy the car. And now you can do whatever you want with it, right? But I'm just gonna hold on to this until you pay me back. Okay, so that's the difference with the contract for deed versus a normal seller finance. In a seller finance, they're gonna actually sign a deed, give you ownership of the property, and they're no longer on title, even if they have a loan. That's one of the biggest hurdles for a lot of people to understand is the separation between the obligation to repay a debt and the ownership. You can transfer ownership to your property, doesn't relieve you of your obligation to repay the debt. That's still there. Does that make sense? We talked a lot about lease options and rent to own. Who knows what a seller carryback is? So let's say you give the seller a chunk of money and then they finance the rest. So they're like in second position. So they got part of their money, their equity, or paid off their loan or whatever, and then they become still a seller finance, but it's called a seller carryback because they're carrying a note on the back end of you giving them some money. Typically, a seller financing is encompassing the whole purchase price and maybe underlying debt, but a carryback's a little bit different. The seller's in second position. Okay. Some of the mistakes and what to look out for and risks. And this is actually my last slide, guys. Thanks for sticking around. Let's go over this and then do some Q&A with you guys. Common risks. Actually, I just put them up there. I was going to ask you first, but failing to conduct proper due diligence, right? I mean, if you can buy a property, like, oh, I'm going to go buy this property, right? Like Lynn and I, even though we bought our property at 21 years old, 22, right in there, 91, we screwed up. We didn't do anything right. Even though we got the deed and we took over somebody's loan. Okay, this is a whole other story, but I'll be brief. This is how it went down. We're these young kids and she says, hey, why don't you just take over our loan? Remember? I'm like, oh, we can do that. That's great. Awesome. She says, yeah, meet me at the county recorder's office with your cashier's check, our down payment. I'm like, okay, we don't know. Didn't do any due diligence. I didn't even inspect the property. Whew. So this was our closing. We're at the counter, literally the reception's counter at the county recorder's office down in Wichita County.
Closing, right?
Which is,
Kind of.
yes, because we recorded the deed, so I have attended a natural
Yeah.
closing. We met, she signed in front of the notary, the warranty deed. We handed her the cashier's check. So the warranty deed, we own the property right now, it's gonna be recorded. She literally patted me on the back and said, good luck, kids. And she's gone. And we're like, yeah, we're homeowners. We didn't have title insurance. We didn't even look at the title. She could have owed $500,000 on this property. With liens, judgments, everything.
Oh my God.
Luckily, we were dealing with somebody that was kind of upfront.
Our third property we bought.
Wait, I'm still in the first one. What? No, I mean, it's kind of weird because she was a broker with Coldwell Banker. Selling her own property. You would think she might have done things a little bit different. But she wasn't representing anybody but herself with transaction. So was she obligated to do things? She wasn't my realtor. We were the buyer, she was the seller. Okay, so I didn't get any advice, I didn't get any education, I didn't get any representation, I got title to a property, period. So luckily, that turned into our first hard money loan, because Lynn is going to BYU for finance, and she's doing bookkeeping on the side for this very wealthy elderly gentleman that his eyes were so bad. He had to scroll across the screen, this reader screen that he had, one letter at a time. A, this big, to read. So she did all his bookkeeping, receipts, filing, stuff like that. She's all excited, and she's telling him about this house we bought, and he's like, whoa, wait, what? You did what? So he's like, we gotta fix that situation. So he literally loaned us the money to pay off that mortgage, or that loan that we had taken over, and he became our lender. And we did it right. We went to the title company, we had title insurance, and we did all of that kind of stuff. That could have been bad. So things can go wrong, common mistakes. You don't know what you don't know. Do you need representation? Do you maybe want a mentor? You're gonna get in these situations, your clients do. And so if they're asking you about seller financing, if you don't know, somebody does, somebody in this room, perhaps. Help them out that way. Last time I was talking about this with another small team that was in this group. One of the realtors was selling a property, and he got a call saying, hey, are you considering seller financing on this property? He didn't know anything about it. So he said no. Because he didn't know. You're gonna get a no. If you call for your clients and call a listing agent and say, hey, would your client consider seller financing? If they don't know anything about it, or they don't see a way that that might solve an issue for their client or provide some benefit to them, they're just gonna say no. And it's not because they've had a conversation about it with their client and they've come to this agreement, all the positives, all the negatives, and we've just decided, no, we're not gonna do that. It's because likely they don't know how to structure, they don't know how to put it together, or they haven't been presented. So don't call and just ask that question and get a no. Maybe delve a little bit deeper. Is there a circumstance that might exist with your client that seller financing would be beneficial to them if they don't sell it traditionally? That'd be a better question to ask. Something like that, if you're looking for that type of situation. So verifying financials, some seller, like I've bought a lot of properties, seller financing and lease option. I've never had my credit pulled. I've never submitted tax returns. I've never given them financials. Good thing I was an honest, ethical purchaser of those properties, because is it possible that somebody buys a property through creative financing from the seller and then doesn't fulfill their obligations, and it puts that person in a worse position than they were? So that's a common mistake that people make, is not verifying that. I already mentioned that one. Ensuring the property is free and clear of encumbrances. I got lucky. That says, use the example of Tim, because Tim wasn't so lucky. I sold Tim a property, and a month later, he got a notice of default. He had just bought it. I don't even think he had made his first payment yet. And he got a letter that he was in default and the property was going to be foreclosed on. So of course he called me first off. He's like, what the heck? And so in doing very quick research and looking at the recorder's documents on the property, the party filing the notice of default was 2 owners ago. Not me, I had bought it from somebody else, but the owner before that said, I never got paid. And now, I don't know if he was alerted or waiting, And until the title was transferred, I'm not sure because it was a flip for me. I owned it for a very short period of time and then I sold it. And so now he's like, I'm getting my money, and he filed a notice of default. Well, Tim closed traditional at a title company. He had title insurance. Title insurance protects us from the past. For this exact reason. So when somebody says, I want that property, or you pay me $125,000. That's what it was in this case. All Tim had to do was call his title company and said, hey, I got this in the mail. I said, hey, scan it, send it over to me. We'll take care of it. He was done. So somebody wrote a big check, but it wasn't Tim. And that got cleared up because he had title insurance. And that's exactly why I would take title insurance out, even on my lease options. And I would record that trust deed situation. Again, we go into transactions thinking what could go wrong. And we set it up just in case. We hope that it won't. We assume that it won't most times because, you know, we're such good friends and we're working this deal out. But shit happens. And so we set up our transactions to protect our clients or protect ourselves just in case. And when are people most willing to make agreements like that? It's like when you're shaking hands and you're going into the deal, right? It's hard to go back and get those kind of things. So when you're going into the deal, let's just do this just in case. I'm like, I'm not going to miss my payments. I know you're not, but let's just put this here just in case, right? You got to have an exit strategy. What if you do a seller finance transaction or take over somebody's property creatively? You own it, but you've got a call or you have to pay off that seller finance note in 3 years or 5 years. You got to prepare, right? What if we've had plenty of people that we've given the option to buy our property at a future date and they never fixed their credit. They kept making late payments and they couldn't get a loan because they didn't prepare. You got to have an exit strategy. So almost all of my creative financing transactions had a plan B, like usually an extension.
It should be in the contract, right?
It should, you agree that up front, like you give me 5 years to perform on our note. I'll give you $5,000 more if I can't perform in 5 years if you give me another 2 years. That's an example. Set something up to give you a little breathing room that you hopefully don't need, but if you need that extension, if you need the right to renew it, to fix something, then you're going to want to agree up front. I told you on my lease options, I would go in that way because nobody else was at the time. Everybody wanted the deed. Subject to is a big thing. Go get the deed, get the deed. Told you an example of somebody that got the deed and my friend didn't even know he gave the deed. So people want control, right? So when I went in there and said, you know what, just rent to me, I'll buy it later. I usually worked in there after we came to an agreement, then or before we finalized the agreement, we're agreed on the terms. Let's say, hey, we're doing a lease option right now, but if I make all my payments on time or early for 12 months, will you turn this into seller financing to where I can get the deed? And it's the same agreement. Our payment's going to stay the same. The purchase price is going to stay the same. I'm still going to pay you off in 5 years, but can we turn it from a lease option to a seller finance in 12 months? If I show you this year that I'm going to maintain the property, I'm going to pay on time. Most of the time it's like, yeah, if you do that, you prove that you can handle this, then I'll do that. Why would I want to do that? Why would I want to switch it from a lease option to a seller finance?
Then it's your property.
Because then I'm on title, it's my property, right? I'm showing as the owner. What advantage does that give me over exercising an option?
You can refinance with anybody.
Exactly, that's exactly why I want to do it. If I'm exercising an option, it's a purchase. The lender's making the rules. The lender's saying you gotta have this much down, you've got to have, these are the rules to do a purchase loan. Would you agree that the rules are a little bit different on a refinance, especially if you've got a bunch of equity in the property? The down payment goes out the door, right? They're lending a loan to value of the property because you already own it. So it's exactly that reason. So I can exercise my option by way of a refinance. Okay, so that's just one creative way to do that. So I already told you the story of Clint not using the escrow company. One of the big risks that everybody talks about when we talk about this type of a transaction is the due on sale clause. Okay. Mortgages have a clause that says the lender has the right to call the loan due if you sell it. Signing the deed to somebody qualifies, right? You transferred ownership to somebody else. It's not saying what the terms of the sale was or whatever. If you just transfer ownership of the property, because they loaned you the money. They didn't loan Ashley the money. If you deed a property to Ashley, they're saying, okay, well, you gotta pay us back. So they can exercise the due on sale clause. It's a right that they have, but it's not an obligation. And that's what a lot of investors hold on to is like, they never do that. Right? They don't want to own the property. But let's look at the situation we're in today and see if that might change a little bit, because we started buying property in 1991. My first mortgage was 9%. Yeah, see your face, people are interested in that, right? All I've seen my whole career is interest rates coming down. Right? So if I got a 9% loan and I deed you the property, say 5 years later, and interest rates are at 7%, why would the bank exercise their right to take ownership of that property and foreclose on it if they're collecting 9%, so they can re-lend it out at 7%? Right? So all these years of the interest rates coming down, the talk with investors and all the REIT groups, I've never even heard of a situation. I really truly haven't heard of a situation where a lender has exercised a due on sale clause. But what if you have a 3% loan or a 2.87% loan and interest rates are 7%? Now,
That's why we're in the banking situation that we're in right now.
it's kind of different, isn't it?
Yeah.
If they are collecting 2.87% interest from you, and they can loan that money out at 7%, might change.
Has that killed any deals for you? Meaning that you have found that in your own due diligence, seen it to the sale clause and said, I'm not interested.
No, it's part of every deal. It's there. So that's a risk that you have to take. So your plan is, if the lender calls the loan due, they're calling the loan due on the seller, right? Remember, they transferred ownership, but they're still the ones obligated for the loan. So they're saying, hey, you gotta pay us. You sold this property, you gotta pay us.
Sure.
But I want to be involved in that, right? Because I don't want to lose the property. I might have a whole bunch of equity in there. So I got to negotiate with the bank. I've never had to do this, but this is what I would do. I would say, hey, they did this. Maybe I can qualify to assume the loan. And that's something that we didn't really get into. It's like assignments and assumptions. But an assumption, you can assume a loan or take it subject to, but you haven't taken the obligation to pay the debt. A legal assumption is when you go to the bank and you qualify, and you can do this on most mortgages, you can qualify as the new borrower to take over and assume that seller's obligations. Now they're no longer obligated to pay back that loan. You are. So that might be a good solution now, where people are selling a property that 2.87 loan and interest rates are higher. What if you could assume their $300,000 house or loan, give them another $100,000? I mean, figure out a way to give them their equity and take over legally a loan that's an interest rate that doesn't exist anymore. Pretty awesome.
So I feel like a lot of what you're talking about is coming from us as an investor side. You're talking creative and everything, but as a selling agent, when he said if you lost any, when I bring it up to my sellers that I know they can't sell in this market for what they need, and I bring up seller finance, I have to always let them know there is a possibility that your loan could be called due. You also still show up on your credit that you have to make that payment. And so you need to know about this as a listing agent, because it is a great option, but like my clients have all said, no way. No way,
Well,
I'm gonna
there's-
be obligated to that loan and have it on my credit and let someone else pay for it. So
There's two different ways to look at that. Depends on who you're representing. Like, we could do one class on if you're representing the seller, and then the next day let's do one if you're representing the buyer. It's the same thing as if you're a buyer or if you're a seller. You're gonna want different things, right? If I'm a buyer, I want the deed. If I'm a seller, I want control. That's why I led with lease options, is I pushed a certain amount of control back to, or left with the seller by saying, just lease it to me. Give me the right to buy it. Just lease it to me. And then I had to, get over the hurdle of, I don't want to be a landlord, and I'm like, don't worry about it. Here's the terms we'll write in here. If I'm late, or if I don't take care of the property, I'll sign a deed, put it in escrow. All you gotta do is call the escrow company and said, he's in default. No, you got control. I'm out.
Isn't it a concern though, if you are a seller and you're doing a seller finance, it's a concern that the person that you're selling it to, that anything with them could then attach to your property, right?
Well, if you sold the property, yeah, you don't own it anymore.
Right.
So
You
that's
still
why-
own you still own the loan, you still own it,
Correct.
it's still in your name, so that is something that people need to be aware of, that
But that's the point I'm making. If you're representing the seller, you don't want them to give away the deed. Just in the situation I was just talking about. If they want to do something creatively, let's do a contract for deed, or let's do a lease option. Work out the same terms, but if they own the property, creditors are gonna find that property. And they're gonna attach judgments and all this other kind of stuff to it, right?
So is any loan assumable?
somewhere.
Back in the eighties, they had non-qualifying assumable loans. Now, most loans are assumable, but you gotta qualify to take over it.
Okay,
You
so it's just
apply
like
with
VA
it.
or FHA loan, you gotta qualify to assume the loan. What about conventional? Is it the same way?
Yeah, from what I understand,
You just can't assume a loan unless you qualify.
no, so when we're talking subject to or assumptions, there's
That's right.
legal assumptions and there's just assumption. You've assumed somebody's
You can't do a
obligation.
side deal like a. Hey, I'm gonna buy this property and I'll pay the payments and you just keep the loan in your name, that.
That's what most people do. Right, but if they don't want the obligation and you can qualify for assuming that loan, then that's a creative way to get a loan at a cheaper interest rate, but they're still gonna be obligated to that loan.
But if you can't qualify. Then you assume the loan and it's still in their name,
It's not a legal assumption.
so can you record that or?
Record what?
So I guess how would that work? I'm confused.
So,
So if you qualify, I got it. You can take
Right.
over the loan. If you don't qualify and the other person wants to sell you the house. What do you do?
that's where, what we've been talking about with the seller financing,
So you
they're,
still seller finance it
Mhm.
with that particular loan.
That's what the all-inclusive trustee is, that's different than a regular trustee. It's saying there's another obligation on this property. The trustee to secure performance of the seller finance transaction. It's complicated until you've done it a couple of times and you're talking to educated people and you're working with title companies that have done it. But yeah, they have the obligation. That's why you don't do what I did and send them the payment, hoping they make their mortgage payment. You're gonna send it to the escrow company. The escrow company is gonna send it to the mortgage company, keep all the records, make sure the payment's made on the mortgage, and if there's cash flow for the seller, they're gonna get a separate check with their cash flow, but you're essentially making the mortgage payment. They're not relieved of their obligation. It will still show up on their credit report until you pay it off or refinance. Sometimes that's a good thing. Like I was trying to do Clint a solid. He was in foreclosure. I'm gonna start making his payments. He's gonna start having a new history of on-time payments. And I'm gonna repair his credit
So
for
that,
him.
that makes more sense. So you're making his payment. To keep him out of foreclosure, but he's still keeping that same loan.
Correct. Most of the time, these situations happen because there's some sort of
Right.
distress. There's some sort of problem that you're solving for the seller.
And then if you were to record that deed though, then the mortgage company for the seller could say, hey, no, we want all the money right now.
They could.
That's the
I guess
deal.
that's kind of what I was-
They
that's
could.
kind of my
And
question.
then the whole deal is like,
Then you gotta have a plan B, right? That's why in the other column is what's your exit strategy? What's gonna happen?
but if you're
Maybe you
using,
can qualify, but you don't want to. I can qualify, but I just want to work my own deal with you, because I'm only giving you 5% down, the bank wants me to give them 20% down. Worst case scenario, in our situation, if any of those would have been called due, we would have just went and got along.
I guess that's what I was trying to say. Once you record it, the lender's gonna know that what's going
Not
on.
necessarily. There's no trigger event that the county recorder says, hey, let's tell the lender that the property that they have a loan on just sold.
what triggers it?
Usually, canceling your insurance, that's a trigger. If the insurance gets canceled, the insurance company is obligated to notify the lender because their collateral is no longer insured. So as a term from the lender, remember they make the rules. One of their rules is you have to insure this property against loss, because that's our way of getting our money back. So if your insurance just lapses or you cancel it or you don't make the payment, they'll get notified right away.
I think we're kind of maybe thinking the same.
Yep.
No, it's the same thing. It's like, what if? You gotta think these things, well, what could go wrong? And if it does, what are we gonna do about it? Right? Or can we do anything about it? All right, you guys online, thank you. Hey, I've got, I should have done this before everybody left. That QR code, unlike the one on the first form or the first slide, is me politely asking for some feedback. Couple of questions like what you liked about today's training, what you would like to, what you'd like to go deeper into. Maybe I'll put together another one based on the feedback. And I'll probably send this out to the guys that were on Zoom that have already checked out, because we did go over, apologize about that. It's as fast as I could. Talk as fast as I could. But if you would scan that and give me some feedback, I'd appreciate it. And if you have any questions about this and you want to talk about a specific situation, maybe call me, reach out, and I like this kind of stuff, and I'll see if we can't brainstorm on it.
So I got another question. I got a seller finance. I own the property free and clear. I sold it to a guy. He put down 20%, 10-year balloon, right? He's behind on his payment a little bit. So my question is there any way that somebody could come after the property if I own it free and clear? So if he gets behind on something or.
But you said you did a seller financing. You didn't know anything on it, but did you give him the deed?
No,
So it was like, you did a contract for deed?
yeah, I believe so. That's what I'm.
If he's on title, then yes, if he gets in trouble with other creditors, they can attach it to the property, but they can't attach it to your property. Because he's not making his payments, because if you're still on title, it's your property.
Yeah,
As far as the asset is concerned, it's recorded in your name, not his. So they can't come after your property. Does that make sense?
yeah, I don't want anybody to attach anything to mine.
Yeah, so that becomes the problem. If you deed it to somebody else. Right?
So I need to make sure it's deeded, the deed is in my name. Right, say that
You
again.
don't sound sure on how you did it.
Well, I didn't check it, that's why.
Yeah. So two things could have happened. You either gave the deed or you kept it. And then your paperwork outlines the terms of what he's paying you, and how long he has the 10 years or whatever. So only one of those two things could have happened. So it would be called a contract for deed, and it should have used a certain document that says upon this event, the deed will be transferred to him.
I'm just making sure. Because I went through title companies, escrow and all that stuff.
Well, let's look it up. Was it in Salt Lake County?
Yeah.
Yeah, we can look it up. All right, Bill, Christopher, Nathaniel,
Thank you.
thanks, guys.
See you soon.
All right, man. See ya. We're gonna sign off. Call me if I can help you with anything.
Yeah, I have a question for you.